Baweja, Director of Finance with REC, joins us now. Mr. Baweja, good morning. Thank you for joining us. Now, RBI has laid down guidelines for project finance. Can you tell us how much of your loan portfolio will be categorized under project finance, and what about loans which are given to DISCOMs?
As regards the new guidelines of prudential norms are concerned from RBI, that these guidelines have come prospectively. So as per the previous circular, it was to come retrospectively, but on the representation from REC as well as other NBFCs, they have modified it, and now it has come in a very mild shape, and now it is basically it is a pro-business. The guidelines have been issued by them. So now the projects which is going to have the financial closure post 1/10/25 will only be covered under these guidelines. So as far as my regular business are concerned, that is not going to be affected with these guidelines. And if you see that guidelines states that brings a perfect balance between the regulations as well as the regularly doing the business. So it will facilitate the business in a way that with the implementation of the new guidelines, this will keep check on the cost and the time overruns. Most importantly, the provisions which have been earlier suggested by the guidelines was for the under construction project, it was 5%, which has been brought down to 1%. And as of now, the RECs, if you see the books of account of the FY ending 25, my provisioning under the assets was approximately 1%. So we are already making a provision of 1%. And with the new provisions comes into force from October 25, that we will have to make a provision only on the project under construction taking thereafter based on the progress of that project and the disbursements to be made.
Also, Mr. Baweja, help us understand that how much does the project finance guidelines by RBI will impact your business, and how much will it impact your incremental credit growth?
As far as my business model is concerned, as far as REC in itself follows and the other NBFCs also follows the India systems, which have the provision under the ECL guidelines. So whatever provision as per the RBI guidelines has to be made, that passes through the impairment reserve route, not through the P&L account. But having said that, the most important thing is this will be, I'm expecting that this will be a catalyst for the business growth, these guidelines. The reason being that the most of the problems which generally the financial institution face at the later stage of the project, these problems will be plugged in at the beginning of the projects. And the request for the time and the cost overruns will be to a great extent reduced. So we expect this will act as a booster to the business, and it will help to not only to the REC but to the NBFCs, other NBFCs also.
Okay, and Mr. Baweja, help us understand, the company has cut its AUM guidance for FY26. Will you be revising it upwards after this recent change by the RBI, or will it be maintained between that 11 to 13% band?
We have already mentioned that we are expecting that our growth would be around plus minus 12%. And since what has happened that last year our growth was around 17%, but out of which some of the amount which we had received out of the prepayments, of which some of the clients had raised funds through IPO proceeds, and as per their mandate from the IPO proceeds, the prospectus which they had filed with the regulators, they had to make the prepayment to the institutions out of the funds raised through the IPO proceeds. Similarly, in some of the borrowers, those are the big borrowers of RECs, there we had to create some of the headrooms for their new sanctions. So that is why they made the prepayment for some of the projects. So taking all this into account, and you can well understand that being a financial institution, the prepayments are the part and parcel of the game. You cannot ignore the prepayments. Suppose if any prepayment comes, it means my borrowing agencies are strong enough to make the prepayment of the projects. They not taking the loans even up to the lifetime of the project cycle. So that is good for us, but yet ultimately that affects my loan book also. So taking into all these factors into account, we expect that our loan book growth would be around plus minus 12%. But yes, it will be on the yearly basis. Some of the quarters may be a little less, and some of the quarter it may be a little more.
Cost of fund is reduced, and where does it stand for you currently, and where do you expect it to end by FY26?
As of now, my cost of borrowing is 7.11%. And if you see, though the RBI has done the rate cuts, but previously if you raise the funds from the market, the pre-cut, the 2 years and the 5 years bond yield was even lesser. And if you had raised the fund in the last 2 or 3 days, it is much higher than as of the era which was pertaining to prior to the 50 BPS cut. But yet we expect that there will be some moderation in my cost of borrowing. In fact, as far as REC is concerned, we have a perfect borrowing mix, which includes funding from the external agency, that we have the ECB borrowings, then FCNR borrowings, then borrowing through the institutional bonds and the bank's borrowings also. So as far as the bonds are concerned, there will be a little bit, we expect that it is going to little bit reduce our cost. But sometimes what happens that some of the borrowings which we have made in the previous years, that has already the coupon rate which is going to continue till its lifetime. But we expect that it should finally be around 7% plus minus.
And also, Mr. Baweja, the company has 1.7 lakh crores of borrowing plan for FY26. But give us some sense that what will be the borrowing mix?
Actually, you will have to understand that financial institution, every day we see the market, and based on the market feedbacks and their various permutation and combination, we raise the funds. For us, the day when we need the fund, first of all, we don't want to keep any fund idle. We want to deploy the fund immediately as soon as the funds are raised. So the most important point here, on the day of the borrowing, which source becomes cheaper to us. If it is an ECB borrowing, by applying my innovative techniques for hedgings, if it is cheaper to me, then I'll go for the ECB borrowing. In case if the bonds are cheaper on that day, then I'll go for the bonds for bond funding for that. If the bank direct lending is cheaper to me, I'll go for that. But yes, we have the perfect mix, since I cannot have way on even a single source of funding, since my requirement is around 1,70,000 crore rupees. So it will be a mix of all kinds of borrowings.
Okay, Mr. Baweja, great to have you on the show. Thanks for giving us an outlook in terms of your loan mix and the growth plan for the company going ahead. But let's shift focus and talk about the entire fertilizer space. Now, given the recent geopolitical escalation that we had seen between Iran